Accounting Scholars, welcome back. We're going to talk a little bit today about how we apply some of the theories and mathematical relationships we've defined in the previous sections. So what I would like you to do is I would like you to actually write down this problem, because we will be spending a significant amount of time on it in order to help you understand how variable costs and fixed costs and revenue and all those good things relate to the determination of the break-even point, and how you can use that information to help you reach your profit objectives. So in this particular example, a certain company sells its only product for $10 per unit. Okay, that would be its selling price. It does have variable costs, which in order to produce the product are about $3 per unit, and it costs approximately $1 per unit for selling and administrative costs that are associated with that particular product. So that's part of the total variable cost. It is a typical company, so it does have fixed costs of a production at $400,000 per period, while fixed selling and administrative expenses are $200,000 for the same period. So total fixed costs here, again, is going to be a combination of both 400,000 plus the 200,000 or 600,000. Now, we're actually going to have to deal with some tax issues here. So make sure you get down that the company pays their tax at a 20% tax rate to Uncle Sam. Okay, so what do we know based upon that information? First, we know that selling price equals $10. Okay. We also know from the information that variable cost is going to be equal to $4 per unit. And the way we got that again is $3 for the variable product cost plus the $1 for selling and administrative expense. Okay, now we're going to move on to fixed costs, which we've determined are $600,000, and the math behind that is $400,000 for fixed production costs and $200,000 for selling and administrative costs. And then we've also been given information about the tax rate, which is defined as TR here, which equals approximately 20% or 0.2. Okay, so that's what we know. What do we want to know? Okay, so the first question we want to know is, okay, based upon that cost structure and selling price, what is our company's break even in units? So with the information we know, selling price at $10, variable cost at $4, fixed costs at $600,000, and a tax rate of 20%, how do we compute that? Well, the calculations are relatively straightforward, as you can see down here at the bottom of the slide. Contribution margin is the first thing you need to compute, which is basically defined as selling price minus variable cost. And since we know our selling price is $10, our variable cost is $4, that results in a contribution margin of $6. Okay, so contribution margin is very important because you actually do make money on each unit that you sell. So the question then becomes, well, Mr. Schwan, how do I compute the break-even point if I know the contribution margin? Well, here again, the calculation is relatively straightforward. the formula is break-even point equals fixed costs divided by contribution margin. So we know, again, that given here is our fixed costs are $600,000. If we divide that by the contribution margin that we derived, we come up with 100,000 units as the break-even point. And again, here the break-even point is the point where essentially revenues equal costs, and you're not making any money, but you're not losing any money. So it's a very important factor from a business manager's standpoint. Okay, so we know the break-even point in units. What about the break-even point in dollars? Okay, so again, we've got our givens: selling price of $10, variable cost of $4, fixed cost of $600,000, and we're going to do we've done our computation as it relates to contribution margin. As you can see, contribution margin is $6 per unit. But now we're going to do a percentage calculation, which is going to help us derive the break-even point in dollars. So if we compute the contribution margin in percentage, and that equals contribution margin divided by selling price. And here again, as you can see from the calculation, selling price is $6 divided by $10, and that equals a 60% contribution rate. Pretty good deal. So how do we end up then with that 60% contribution rate, determining the break-even point in dollars? Well, the break-even point in dollars then would be, the math is very straightforward. It's your fixed costs, which here again are $600,000, divided by the contribution margin percent, which we derived in the line above, which is 60%, and you can see the math over there to the far lower right. $600,000 divided by 0.6 equals $1 million. Now, as we go through each of these slides, ladies and gentlemen, please make sure you're taking copious notes so that you understand the math behind these particular calculations, because we will be using them over and over again in our work in this chapter and later chapters. All right, guys, we're at the 10-minute mark. Please review this video carefully. It's an important one, and look forward to seeing you tomorrow night and in class tomorrow. Bye-bye.